Today, we will discuss about the milestones of a startup journey: egg seed stage, early stage, growth stage, exit stage, Series A, B, C. You might have a general sense that these stages are indicative of progress, but actually where one stage ends and another stage begins. I think a lot of people don't understand the specifics around, right? So first of, we have the ideation stage, and pretty much all of us have been there at one point or another. The startup is literally just an idea at this point. Maybe the founder or founders see this gap in the market. They think they might be able to fill it with a product or service, and that's the ideation stage in a nutshell. Now, when ideas turn into actual planning, when the founders sit down and come up with a company name, and they start to map out a possible revenue model, and they come up with some milestones that they want to hit in the future, well, that stage is aptly called the planning stage. Now things start to get a little bit more tough during the third stage, called the commitment stage, and this is where the founders have to stop talking and start doing. They sign a shareholder agreement and the company is formally registered, and most importantly, they start building an MVP, a minimum viable product. Now, all three of these stages actually fit into a larger funding stage, which of course only really applies to the startup who are planning to raise external capital. Once that are, we call them bootstrap startups. But for ones who are planning on raising money from investors, this larger funding stage is called the pre-seed stage. Now investors in this stage can consist of the founders themselves, family and friends, sometimes crowdfunding is an option, and occasionally angel investors as well. Next stage a startup enters into is called the validation stage. At this point, the MVP has already been built or is very close to being finished, and the startup has begun testing this MVP in the market. They're selling early versions of the product to consumers, or they're offering their service in a limited capacity, and they're collecting a lot of data. Basically, the goal during this validation stage is to achieve product/market fit, and you will hear that term, product market fit, thrown around a lot in the startup world. But in a nutshell, what it means is that the startup's product or service is generating a lot of demand from customers. Now, that might seem very straightforward and easy thing to do, but in reality, achieving product/market fit can be really hard. What it boils down to at the end of the day is separating people from their money. You have to convince them that your product or service is worth paying for, and yes, some startups do get lucky, and they just stumble into product/market fit. As soon as they launch their MVP, it sees tremendous response from the public. But for a lot of startups, the validation stage lasts way longer, and they may end up spending a lot of time experimenting before they're able to achieve product/market fit. Now, of course, this goes without saying, but the experimentation costs money. Building multiple prototypes for a consumer goods startup, or adding and removing features in a software or internet startup requires huge financial resources. And so this is where we move out of the pre-seed funding stage and into the seed stage, where you'll have angel investor coming on to provide guidance, support, connections, and of course capital to keep the startup afloat. Also at this point, because the startup has an MVP now, and they're generating some revenue, they can also begin applying for grants. They might even be able to secure a loan, or if they're okay with selling equity, they might start to get some attention from micro VC firms, accelerators, and incubators. Okay, now that I have finished explaining what a seed stage is, or the seed funding round, I can explain the next terms here. It's kind of odd one out, and it isn't that every startup raises, but it has become popular in the last couple of years, and that is the pre-series round. It sounds like a big deal because it has a Series A in the name, but really what this is a second seed round. In fact, you could basically replace the term pre-series A with seed round number 2, and it would mean literally the same thing. It's a round raised by startups who are still searching for product/market fit, or they found it but they need a few more months to raise their Series A. but they don't have enough money in the bank to get there. So you can think of a pre-Series A as a bit of a bridge round, giving the startup enough runway to make it from seed to series of funding. Now the moment the startup achieves product/market fit, which again means that the market a startup is targeting is excited about and ready to pay for a startup's product or service. The moment that is achieved is the moment the startup leaves the validation stage and they enter into the growth stage. And the idea here, as the name suggests, is to grow. And this stage can actually take a very long time. And in fact, by the time this stage is over, the startup will likely no longer be a startup. It will probably be a fully fledged company. During the growth stage, a company will take their validated product or service, and they'll start selling as much as they can, and the primary goal here is to increase revenue. That's the growth we're talking about, revenue growth. Now, revenue growth during the growth stage typically comes at a huge cost. It will usually increase as expenses increase, meaning that the company will either break even or lose money on a quarterly basis. So this is where the next few funding stages or series come in to sustain those losses. After seed stage, and possibly after raising a pre-series of rounds, a startup will usually raise a series of round, which is the first of many funding rounds following the same naming structure, Series A, B, C, and on and on. Flipkart, before it was acquired, they'd made it up to their Series G round. So I don't know if there is an upper limit to the number of alphabets that you can tap onto the word series, but coming back to Series A, what differentiates a Series A from a seed round? A seed round is meant to be used by a startup to achieve product/market fit. Basically, this is building the foundation of the business, and a Series A is meant to be used to chase growth and fast, basically quickly constructing the frame of the skyscraper that sits on top of the foundation built using the seed money. Now, like I mentioned earlier, the growth stage of a company can last a while, and sometimes this is by choice. Maybe the company wants to massively grow their user base before they start to monetize it. But sometimes this isn't by choice. Sometimes a company genuinely isn't able to monetize their user base. They don't know how, and they keep growing. But eventually investors will stop pouring capital into this kind of company, and it will quickly need to figure out how to become profitable or go out of business. Now, where things go from here does vary from company to company, but there are two main possibilities. A growth stage company can go straight to the exit stage, or they can continue on to the scaling stage. And let's talk about the scaling stage first. This is a stage where the company learns how to increase its revenue while spending stays the same. So this, of course, eventually results in massive profits, which can be used to make the business bigger and better. And companies will still raise funds from investors here, usually at a Series C level and up. But the goal here isn't so much to survive as it is to just accelerate the scaling process. From here, once again, there are two possibilities. The scaling stage startup can go straight to the exit stage, or they can continue on to the establishing stage. And I'm gonna leave the exit stage for the last, because that truly is where the story ends. But you can think of the establishing stage as a company's golden years. They're still kind of in that startup mentality, so the founders haven't left, and there's still a very clear thread linking the ideation stage to the establishing stage. And the goal here during establishing stage is usually domination. The company is the market leader, probably in multiple global markets, and will just continue to expand. Basically, things are going so well that nobody wants the party to end. Like all good things though, eventually it does come to an end. And this is finally when we reach to the exit stage. There are two ways this can play out. The company can 1. Go public, or 2. Be acquired by a larger company.